Hi there. My name is Craig Basinger. I'm the Chief Market Strategist at Purpose Investments, and thanks for clicking on our video update for the month of June 2025 entitled Buy the Dip and Trim the Top. Question mark on the top, of course, because we never really know until well after the fact. But we recently, in the last few days, have reduced some of our equity exposure after doing some buying during the weakness at the end of March, beginning of April. And just wanted to share our views on what we think is going on. And I think it's fair to say there's a fair bit of good news out there. But we'll start just with our quick disclaimer. Please read at your leisure. So no denying 2025 has been a pretty wild year so far. This is the S&P 500 from the start of the year. Obviously, we got down to almost 20% drawdown, and since then have recovered pretty much all of that decline, which is obviously quite impressive. The weakness, it did surprise us initially as markets, remained pretty resilient in the first few months of this year, despite the increasing trade tensions. But then obviously all that changed in March and then in April, where we had one of the faster corrections in history for the S&P 500, and then obviously got on the Liberation Day announcements, got almost down to 20%. Before staging a pretty impressive recovery. And I would say that a lot of the tariff uncertainty has cooled. I wouldn't go as far as saying there's clarity, but certainly less concern than there was a few months ago. And negotiations have started and some progress has been made. There's been more each few days, which is certainly encouraging, as enabled markets to stage a pretty strong rebound. I think it's important to note this was a policy-induced correction, and policy-induced corrections tend to be pretty short-lived, and because primarily they are self-inflicted. And some days you'd get Dr. Jekyll showing up and saying negative things, and other days it would be the more market-friendly Mr. Hyde, and that's what we have had more of late. But I wanted to, quickly highlight, a couple different things. One, well, the S&P is, up a little bit year to date, maybe just marginally. The TSX has actually done quite a bit better. And I think a lot of that goes to gold and sort of some components of the TSX being sort of lower valuations, which has certainly helped quite a bit. But the real star has been international, which international markets are up quite considerably year to date. And they have also benefited from this sort of rebound in markets. And also the drawdown in markets wasn't nearly as severe. So it's been a pretty exciting year. And again, international markets outperforming the US, something we've seen little quits of over the last few years, but the US has still remained the dominant performer. Perhaps that's changing a little bit so far in 2025. The big driver of markets has been trade uncertainty. There's no denying that, and this is just an index of trade uncertainty, and obviously it's spiked materially higher than it did even during the tariff wars of 2018, 2019 between the U.S. and China. And not surprising, when tariff uncertainty peaked, that's pretty much where the bottom was put in for markets, and since tariff uncertainty has been fading, the markets have largely been recovering. But it's not just tariff uncertainty. I mean, if you throw in other countries, whether it's Germany, ECB, other central banks, the amount of policy uncertainty is certainly higher in the last few years than we've seen in the previous sort of decade or couple decades. And I think this is something that people and investors should keep in mind. Policy is no longer, always positive for markets, and this heightened uncertainty around policy is certainly adding to volatility in the markets. And this chart, I'll just pause here for a quick sec, but this chart I think is quite impressive and sort of paints a pretty good picture, because what we've done here is just showing the S&P 500 in a log scale, and then the Fed funds, so that's central banks, whether they're cutting or increasing interest rates. And what we're pointing out here is that, from the late 80s up until about 2021, anytime there was a period of market weakness, the central banks, and this is the Fed in this example, would sort of come to the rescue of markets. And that was this environment where, the Fed put is quite often commented on, where, hey, policy has, Mr. Market, policy has your back. Now, I think it's interesting to point out, one, this wasn't always the case. If you go back to the early 80s, 70s, and even 60s, policy actually drove a fair bit of market volatility. It wasn't quite as supportive of asset prices all the time. And I think we're in this environment where it's not nearly as supportive as it was in years past. And I think this is something new for investors because if you look at the last 20 some odd years, that certainly wasn't the case. And I think that's the environment we're back into. You can you can blame that on a whole bunch of different factors, whether it's inflation, whether it's just government trying to change policy and effectuate different agendas. Whatever the reason, policy is no longer completely supportive of markets. And I think we've seen that certainly so far in 2025. Now, every correction is different. I think they can be caused by a number of different things. The most common, I think that what most of us kind of understand is economic weakness driven kind of corrections in the market where, hey, the economy's slowing down. We're worried about earnings growth. We're not going to put as high a multiple on earnings, and those could come down as well. So you get this sort of corrective kind of environment. And that is probably still the most common. But we would point out, the last three have not been this kind. In 2020, we obviously had COVID, and that was an exogenous shock kind of correction. In 2022, we had a spike of inflation that caused a market correction, which again was very different. And then obviously in 2025, we've had this policy-induced kind of correction. And these unique corrections we're going to call unique because they're not driven necessarily by economic weakness, even though that may align with some of them. But because they have they're a bit more unique, the standard pieces of defense within a portfolio, some have worked better, some have worked worse during these past three, let's call them unique corrections. If you look at COVID, I mean, TSX and International did terribly. Bonds, the US dollar did really well. Gold was sort of in the middle. In the inflation-driven correction of 2022, international and bonds did terribly. The US dollar was actually a bit of a star. The TSX actually did quite well because of more resources. And then you look at the trade 2025 policy-induced correction, and international actually did okay. Bonds did so-so. The US dollar was nowhere to be seen as far as a helper for portfolios. And then gold shined really brightly. The point is that if we're going to have more of these kind of unique corrections, and if policy is not always going to be there, then I think people just have to think more about their defensive components within their portfolio and, increasing the sort of diversity of where they get defense, whether it's more international, whether it's more momentum or CTAs, whether it's more alternatives, whether it's more gold, just different kind of strategies to complement sort of that core bond portfolio has become clearly more impactful. So where do we think things are going in the near term? Obviously, we said that we reduced equity exposure, and we did so by trimming America. This is our chart of sort of how we expected this year to sort of go and progress. And again, like this, I'm sure will be proven wrong as time goes on. The market is quite good at doing that. But this is our sort of framework. And our framework was pretty straightforward. We thought uncertainty would cause some sort of period of market weakness. We thought it would happen sooner this year. It didn't. Happened a bit later. We didn't think it would obviously be that magnitude that we saw. This is global equity markets is the black line here. But it certainly was that period of weakness that we had been expecting, but we had thought that would fade or that uncertainty would fade and the markets would stage a rebound. What we think happens next is we get this environment where, we think we could see a period where the economic data starts to roll over and the earnings start to roll over. And we're starting to see little bits of that. And we think that will cause another period of market weakness in the summer months. So yeah, we reduced equity exposure and parked some of that money in bonds. And we're just talking about our multi-asset strategy here. So why trim America? It's not because of their new leader. It's in part because that's where we added equity during the market weakness. So we're just sort of taking that trade off the table. Obviously, it worked out relatively well. Not saying we bought at the bottom. We bought a little bit early, but it certainly has played out quite well for us. So we're taking some off the table. And the reason we're, taking it off the table as well from America is a bit on valuations. Earnings growth has been coming down across the board. There's no denying that. It's probably coming down. This is all US dollars, so it sort of inflates a little bit of those international earnings. But Nonetheless, we're seeing earnings growth decelerate. This is the US on the left-hand side here, pretty materially from 2024 into 2025. The challenge with the US, more so than these other markets, is the valuation is still very high. We're still trading at 22 times earnings after this rebound for the US. And 22 times earnings with, 6% earnings growth is a very challenging market to sort of hold on to those gains. So we think there's more risk in the US market at this point, probably less on the international side, which had us trimming on the US. And we do think we could be in for a tough summer. We'd love it to be a quiet summer because obviously it's been a tough year so far and a very volatile year so far. But we do think things are lining up for a bit more of a challenging summer. And where this is coming from is one on the economic side. The economy, the economy has been really interesting. This was a policy-induced correction, and the economy was doing just fine. In fact, some of the growth was possibly brought forward into Q1 and early parts of Q2 because people were front-running tariffs. And a lot of the hard economic data held up relatively well. But I think what we're starting to see is that data is starting to show up a little bit weaker, a little bit weaker, a little bit weaker. And we do think that more of that soft data caused by that extended period of uncertainty, and possibly that we drew some of that economic growth and enjoyed it earlier this year, may lead to sort of a growth scare in the summer months. And we are starting to see that. This is the Bloomberg Economic Surprise Index that you're looking at here on the right-hand side. And the total is sort of all the different indicators and inputs into it. And obviously, we've been commenting that survey data has been very soft for a while, but the hard economic data has held up. That's that blue line at the top. But that's now starting to roll over. So we do think we are at risk of seeing a bit of a growth scare in the coming months, which is one of the reasons that we're a little bit more cautious. And the other is on earnings. As we said, earnings estimates have been coming down both internationally and in the US. Again, more challenging in the US because of the higher multiple. But there's other aspects going on here. We think earnings have been grinding lower, but not moving materially quickly. But as we move into July, we're going to go into a pause on buybacks because of its earnings season, and companies stop all their buybacks during earnings season, which could lead to some volatility and some weakness as that sort of support for the market, fades to a certain degree. And the other aspect is, last earnings season, we saw a number of companies just pull guidance. They didn't actually guide down. They just said, we don't know what's going to go on because we don't know what's going on with tariffs. So they pulled their guidance. And we think as this earnings season gets going, we're probably going to see more of that and or softening of future looking guidance. So we do think currently earnings estimates are at risk of falling a bit further. Now, there's some other factors going on. Obviously, the tariff uncertainty still remains, but it has cooled. But we would point out, tariffs were given a 90-day pause across the board, and that expires in July. Don't know if it'll be extended, but we'll see how that sort of works out from that perspective. I think the other thing to consider here is we do have deficits that are becoming increasingly concerning. And I think that's a bit of an issue. We don't think it's a material issue, but we are a bit concerned about bond auctions. We've seen some of the higher yielding bonds move higher, and people are becoming increasingly concerned over deficits. And I think that's a bit of a risk as well. We don't think it's material, but it could certainly flare up in the summer months. But the key takeaway here is, we've had more of these unique corrections, which do require better diversity. And we do think people should be carrying a little bit more dry powder as it comes to their portfolios in case we do see that period of weakness. We're using bonds, obviously, but we're holding a bit more cash, and we have some other strategies that are sort of diversify our defense a little bit more. So how are we positioned? After what we've done, after the sort of trimming of the U.S. exposure, we are certainly defensively tilted. We have a mild underweight in both equities and bonds, and we're holding more cash and more diversifiers. On the equity side, after that trim, we have a mild underweight on the U.S. side. We're about neutral in Canada, and we certainly have more on international. We are still continue to be positive on international markets. On the bond side, we do carry a fair amount of duration. Again, duration is bad news if we have another inflation scare or if these yields keep moving up. But if we do get that period of economic weakness, we do think duration will be a positive for the portfolio. So that's why we're carrying a decent amount of duration and less credit exposure. And then obviously, like I said, in our diversifiers, we're sort of leaning on vol management and some derivative option premium harvesting type strategies, but that has our defensive component of our portfolio, we think, relatively balanced and well positioned for the summer months. So again, I think trade uncertainty has peaked, but policy uncertainty will persist. And whether it's the tax bill or other components or other international areas, we think uncertainty and policy uncertainty is something that is probably here to stay for some time. We do think that requires a more diversified defensive stance within portfolios. Bonds obviously remain the core, but then diversifying even those bonds to either alternatives, real assets, momentum, international equities, just getting defense from different areas. We do think an economic growth scare is likely, but probably not a full recession. The reason being is that even though the US consumer is weak, the global consumer is actually very healthy, which I think is a positive. And we don't think there's any excesses in the system at this point in time. So we do think people should be a bit more opportunistic, trimming to strength, adding to weakness. That's what we've been doing. And so far, that's been working out quite well. We do think this is going to be a challenging year. If you do not already get our content on a regular basis, listen, we publish Market Ethos every week. We publish our more portfolio construction thoughts on a monthly basis. So if you are not receiving these already, please feel free to sign up. Just go to purposeinvest.com. Up there under platforms, there's Purpose Portfolio Strategy is in that drop down. Select that. And if you scroll down a little bit, you'll see some of our past reports. You can see if you want to receive them by clicking or reading through a few of them. And then there's this option here to sign up for portfolio construction and market insights. And with that, we think it's going to be a challenging summer. We're going to hope it isn't, but we're certainly prepared for it to be challenging. If you have any questions, feel free to reach out to anybody on the team and or your Purpose sales representative. And with that, have a nice day.